Okay, I think we're ready to begin.
Yes, we are.
All right. Well, hello and welcome. I'm Matt Coyle, and I'm here with my partner,
Yin Coyle.
and we are Team Coyle at Compass Real Estate in Wellesley, Massachusetts. We're local real estate agents, primarily helping buyers and sellers, investors in the Metro West region of Massachusetts.
Right.
So, Yang, what are we talking about today?
So, Matt, we're going to be talking about our July newsletter. So, first question for you is, how's the real estate market?
Good question and a good place to start. I think the market is very much a seller's market, but we are seeing conditions change on the ground. For instance, and you can attest to this as well, is that we're seeing less foot traffic at open houses.
And less competition for offer.
So we're seeing a decrease in the number of offers.
Right.
And then I guess the one that's really big is we're starting to see negotiation come back in the process.
Right.
Because
like home inspections, contingencies, price, right?
Exactly. So I mean, one of the fundamental factors absent from the sales process in the last year or two, let's call it the COVID era, was negotiation. It was largely a seller's market where they would dictate terms, and the buyer basically had to comply.
That's right.
So
very one-sided.
Very one-sided, and I'm more in favor of a balanced market. We're not there, but I think we're starting to see it come back slowly, and I think that will continue to trend that way throughout the rest of the year.
Sounds good. And you're talking about real estate as an investment tool. How does it compare to other investment asset class?
Well, it's a question that we addressed in an earlier newsletter this year about how does real estate compare to other asset classes in an inflation environment. Now, historically, the trend has been very clear that investing in real estate is a good hedge against inflation. But let's look at some numbers for the first 6 months of this year. And remember, we started the year at an inflation rate at 7%. The December number came out in January. December CPI, Consumer Price Index, in January was 7% inflation, which was a 40-year high, if you recall.
Yeah.
Today, it's at 8.6%. Still around that 40-year high mark. And let's give some numbers to kind of put some meat on the bone here in terms of how real estate's performed to other asset classes. So if we look at the Metro West region as of June 30th, and this number's a little raw because we haven't got the final number, but it looks like we're up roughly 16% year to date from January 1 to June 30th. Versus the year before. So that's a positive 16%. Now, if we look at the S&P 500, that is down roughly 21% over the same 6 months, the year-to-date return. Gold futures are down 2.41%, and U.S. corporate bonds were down 14.39%. So all these other asset classes are turning negative, not surprising with the rise in interest rates. But real estate seems to be holding up pretty well. So what we said earlier, that is a good hedge against inflation, seems to be proving itself to be true this time around as well.
Yeah, that's good news, right?
Yeah, no, it is good. If you own real estate. If you don't.
Own that. Yeah. Or you're sold last year.
Yeah.
You gained a lot of capital gain. So
Now you got to figure out where to put it.
Right, that's right. So what is Team Coyle's forecast for the home price for 2022 next year? So
for 2022, we expect home prices to increase at a decreasing rate this year throughout the remainder of the year. It's still very much a seller's market. It is changing, we note it, but I think what you're seeing is a slowdown in demand. Supply is not really changing that much. You're getting some incremental increase, but not enough to offset the imbalance we have in the market. And that's really what's underpinning this increase in price is the supply-demand imbalance in favor of the seller. And then for 23, We expect real estate prices to come under pressure from certain side effects that we're going to talk about later in your
There
questions.
are four side effects. Okay,
Right,
let's
okay.
jump into it. How about that?
Sure, go ahead.
Okay, so first side effect you talking about is higher interest rates.
Right. So one of the side effects of inflation is inflation. First of all, represents a general increase in the prices of all goods and services in the economy.
True.
Okay. I'm not going to talk about what causes inflation. That we can do that in another episode. But clearly, it's bad for the ordinary American. So the Fed has a mandate to keep inflation around 2%. We are roughly around 8.6%. It's not exactly the same measurement they use. I don't want to get distracted on that, but clearly they're behind the game in controlling inflation, and it's certainly above their tolerance of 2%. So the best way the tool that they use to reduce inflation in the economy is to raise interest rates. And that's one of the side effects. And you're seeing that through higher mortgage rates, where mortgage rates today are for a 30-year fixed rate mortgage is around
More than 6.
it's about 6%,
Yeah, more than 6.
depending on which day you look at.
Right.
And the Fed has indicated very clearly that they're going to raise rates another 4 or 5 times this year. They know they have to do it. Hopefully they'll continue to do it because we got to get our hands around inflation. But that's one of the side effects, and it's really creating affordability issues for
The home buyers.
home buyers.
Yeah, that's what we talk about, the second side effect.
Right. So it's a
That's
natural segue into our second. Yes. So go ahead.
So affordability and shrinking demand.
Right. So the affordability is just making the cost of purchasing a house more expensive, and it's pricing people out of the market. Primarily,
Especially first-time home buyers.
First-time home buyers.
Because their budget is limited.
the other thing you're seeing is people readjust their expectations in terms of their price point that they want to buy. Instead of $1 million home, they're looking at, let's say, an $800,000 home.
Some people just sit on the fence and they're not moving anymore.
Right. Yeah. So some people don't know what to do, but high interest rates and inflation are going to be here, in my opinion, for a while, at least until next year, and probably maybe even thereafter. We'll have to see. It really depends on what the Fed does, what Congress does. There's a lot of things going on that affect inflation and interest rates, and we'll see. So that's it. So that's going to the shrinking demand, the affordability shrinking demand is kind of, oddly enough, kind of rebalancing or making the supply-demand imbalance go away. We're not there, but instead of supply of houses increasing, we're seeing demand decrease. And, that's going to, if you're looking to buy and you have the funds to buy, and you can afford it, there'd be opportunities where the prices are getting dropped.
That's right.
So.
Yeah. So the third one you're talking about is recession and higher unemployment rate because of the inflation.
Right. So in a recession, let me define what a recession is. So a recession, the way the so-called experts define it is 2 consecutive quarters of negative GDP. In the first, the gross national product, gross domestic product of an economy. Yeah. So in the first quarter, GDP was minus 1.4%. The second quarter hasn't come out, probably come out in July. I already think we're in a recession already. I think clearly the mood of the country is there. People are facing higher food prices, higher gasoline prices, and that translates into less ability to buy other things because you only have a fixed amount of money you make each paycheck.
Yeah.
So
unemployment rate too, right? That's what you're going to talk about.
Right. So I think the economy is starting to slow down, and that's one of the side effects of inflation. And I think you're going to see that progressively continue throughout the year and probably into 23. But a lot of this can change based on what happens, Fed actions and so forth. It could get worse, it could get better. We'll see. But one of the things that typically inflation leads to is higher unemployment due to a recession, because as people consume less because they're paying more for their goods and services due to inflation, they have less disposable income to spend. So they buy less other goods, and businesses no longer need to produce at that level that they historically have. So they lower their production levels, which means, do I need to keep all the people that I have on board today for a lower level of production? And the answer is generally no.
We're already saying there are some companies that are reducing workforce.
Right, there's layoffs, and I wouldn't be surprised. I hope it's not the case, but I wouldn't be surprised if in the next month or so we start seeing companies revise their earnings outlook, and then ultimately that may lead to layoffs. And right now, unemployment, I think, is at 3.5%. Very low, great number, historically, great number, but I could see that number going up. It won't happen overnight, but it will gradually go up and I think we'll watch that throughout the remainder of the year. But the point about that in relation to real estate prices is that, just think of it logically. If you're unemployed, you're not able to buy a house, you can't get a mortgage, you'll get denied. Or alternative, you're a seller.
Homeowner, you cannot pay your mortgage, you might go to default or short.
If you don't have any other funding mechanisms available, you might default on your mortgage, in which case you go foreclosure, or you might have to sell your house at a distressed price. So that's going to put downward pressure. So you're going to see shrinking demand because of the higher unemployment, but you're also going to see potentially sellers getting out of the market for bad reasons. One, they can't afford their current mortgage commitment. So go ahead.
Yep, that's true. And the fourth side effect because of inflation, I think it's a very good point. I never thought about it, but you mentioned this property tax. Property tax.
Very, very important point. Property taxes are largely there to fund a town's expenses. They have really no other funding mechanism. So if you think about what a town's budget is made up, it's largely people, and the biggest piece of that is education. Okay.
Yep.
And as expenses go up for people, they're going to want increases in their salaries and so forth. And guess where that's going to come from? It's going to come from you, the homeowner.
Yeah.
And that means your property taxes better than average chance your property taxes are going up. That's just going to make it more expensive for people that currently live in an area, especially if you're on a fixed income, you're a retiree or you're an empty nester, to afford these increases. So it's another factor, another side effect of inflation. We're going to watch these four issues progressively throughout the year and see how they progressively turn out. But we'll keep you posted. But we hope you find this helpful.
Thank you. So, Matt, if people have more questions, how they can contact us?
Yeah, we'll put a link to this newsletter, which can be found on our website as well. It hasn't been posted yet.
The link of the website going to be here.
Right, it's on our blog, our blog page, and it should probably be coming out shortly after July 4th.
Sounds great.
Okay?
And please subscribe or share and like our YouTube video. And we really appreciate that.
And if you have any questions that you'd like us to address, or issues or topics, we'll be glad to. We're always looking forward to invite experts from the outside.
Yes,
we had a recent episode on
1031 exchange, right?
which was good.
That ones are really good.
Yeah, we got a lot of good feedback on that. So well, thank you very much, and have a great 4th of July weekend. Bye-bye.
Bye-bye.
Woo!